Hey everyone, welcome back to the channel. I'm your host Ian, and today we're diving into how Canada's 1980s and 90s recessions shaped today's economy. The 1980s recession, which hit Canada hard from 1981 to 1982, was triggered by a perfect storm of factors. Inflation had been raging through the 1970s, fueled by global events like the OPEC oil shocks that sent energy prices skyrocketing. By 1980, Canada's consumer price index was up around 10.2%, climbing to 12.5% in 1981. To fight that, the Bank of Canada jacked up interest rates, peaking at a staggering 21% in August 1981. This was partly in response to similar tight monetary policies in the US, where the Federal Reserve under Paul Volcker was also battling double-digit inflation. But because Canada is so tied to the US economy, their policies rippled north. US credit controls in early 1980 tanked demand for Canadian goods, and a floating exchange rate devalued our dollar, making imports pricier and inflation even stickier here than south of the border. The impacts were brutal. GDP shrank by 3.2% in 1982, with a deeper 5% drop during the main contraction phase. Unemployment soared to 12% by 1983, even as the economy started growing again at 2.6% that year. Regions like Alberta felt it extra hard. With the end of the oil boom and overall full-time jobs took almost 4 years to recover fully. Inflation did start cooling to 5.8% in 1983, but at the cost of widespread pain, including higher food and consumer goods prices up 11 to 12%. Recovery kicked in by late 1982, with GDP bouncing back strongly, and by 1984 to 86, Canada had some of the highest growth in OECD, but unemployment lingered above 10% until 1986, showing how the recession can leave those nasty scars. Fast forward a little bit to the early 1990s recession from 1990 to 1992, which is even more severe in some ways. Inflation psychology from the 70s and 80s hadn't fully faded. CPI was still around 7% in 1991, and people were speculating on real estate with debt-fueled bets, thinking prices would keep rising forever. The Bank of Canada responded with high interest rates again, hitting nearly 14% in 1990s to stamp out those pressures. Add in the global commodity price drops, the introduction of the GST, and massive public debt from prior deficits, and you had a recipe for slowdown. US influences played a role here too. Their restrictive policies in the late 80s echoed ours, and since 3/4 of our trade is with them, their slowdown dragged us down too. Unemployment recovery was painfully slow. Wages froze or dropped for many, and it took years for jobs to rebound. Public debt ballooned to 68% of GDP in 94 to 95, with interest costs eating up a third of revenues. This era also saw labor market shifts towards lower paying, insecure work, a trend that started in the 80s but deepened here. Now, the recovery strategies in the mid-90s are where the real lessons shine. Under Prime Minister Jean Chrétien and Finance Minister Paul Martin, the 1995 federal budget marked a turning point. They slashed program spending by 9.7% from $118 billion in 1994-95 to about $108 billion by 96-97. Public sector jobs dropped by 45,000 or 14%, and departments like transport saw 51% cuts. Provinces followed suit, reducing spending from 22.2% of GDP in 92-93 to 18.1% by 97-98. With places like Alberta cutting 21.6%. They reformed transfers too, creating the Canada Health and Social Transfer to give provinces more flexibility, dropping federal transfers by about $4 billion. This fiscal discipline flipped deficits to surpluses starting in 97-98, peaking at $19.9 billion in the early 2000s, and trimmed debt from 68.4% of GDP to 29.9% by 07-08. Interest costs plummeted, freeing up money for growth. Free trade deals were another key pillar. The Canada-US trade agreement in 1988 laid the groundwork, but NAFTA in 1994 supercharged it. Trade with the US exploded. Goods exported up 166% from 93 to 2016. Imports 150%, and US FDI into Canada surged 404% by 2013. This boosted our GDP per capita by 33% from 97 to 2019, helping pull Canada out of the recession slump by opening markets and encouraging efficiency. Sure, some jobs shifted, auto manufacturing lost positions to Mexico, but overall, it supported a 15-year boom. Global influences, especially from the US, were huge. Their anti-inflation hikes in the 80s forced our hand, and in the 90s, shared trade ties meant the recovery helped ours via NAFTA, but it also highlighted our vulnerability. US recessions in 74, 75, and then 81 and 82 directly impacted us, with the latter being severe here. So how does that reflect into today? The parallels to high debt, inflation fears, and the cause for fiscal prudence are strikingly similar. Post-COVID, federal debt jumped to levels echoing the early 90s, over $1 trillion now, with deficits like $55.6 billion in 2009-2010 during the last crisis. But even bigger recently, inflation hit 8% in 2022, driven by supply demands, spending surges, and global shocks like the Ukraine war, similar to oil crises back then. The Bank of Canada was a lot slower to react this time, keeping rates low too long, letting inflation kind of fester. Unlike the aggressive hikes in the 80s and 90s that brought it down from 13% to 2%. That delay meant higher rates later, squeezing households, especially with mortgages where costs are up to 6.2% and hitting younger, lower income folks hardest. The big lesson? Fiscal prudence works. The 90s cuts and surpluses sparked growth without endless pain, but ignoring debt like in the 80s led to stagnation. Today, with the debt at 34% of GDP and rising interest costs, we need targeted spending restraint, not just hoping for revenue growth, echoing failed 80s tactics. In real estate, this means watching for rate cuts that could ease mortgages, but risk reigniting inflation if timed wrong. Avoid past mistakes, act fast on inflation, prune budgets wisely, and leverage trade for stability. Thanks for joining me today, and I look forward to seeing you on the next one.